So, picture this. It is 1877, and Cornelius Vanderbilt passes away.
Okay.
And he leaves behind this massive fortune of like $1.5 billion. And that is adjusted for inflation, obviously, but still.
That is just an incomprehensible amount of money for that time.
Right. But then if you skip ahead just 4 generations, by the time his granddaughter Gloria Vanderbilt passes away, her estate had dwindled down from an estimated $200 million to just 1.5 million.
Wow. That is a shocking economic fall.
Yeah.
I mean, for one of the richest families in American history.
Exactly. But now let's look at another titan. So John D. Rockefeller had that exact same $1.5 billion net worth in 1937.
Right.
But today, his descendants share a fortune that's estimated at over $10 billion. And that wealth, it supports over 200 family members, and they still give away like $50 million a year to charity.
It's wild. You have two families, right? Starting with the exact same unimaginable wealth, experiencing two completely different financial trajectories over a century. I mean, one fortune evaporates and the other just multiplies.
And that contrast is really the entire mission of today's deep dive. We're looking at how the ultra-wealthy keep getting wealthier, while, statistics show that 90% of families lose their fortune by the 3rd generation.
It is a massive drop-off.
It is. So today, for you listening, we are unpacking the, highly controversial financial engine behind this kind of generational wealth retention. We are pulling from case studies from Cathmere Capital and Vantage Capital.
And we're also digging into the infinite banking concept, right?
Right.
As pitched by the Nelson Nash Institute and Garrett B. Gunderson's book, What Would the Rockefellers Do?
Right, but we aren't just taking the billionaire pitch at face value here.
No, absolutely not. We are cross-referencing all of this with a pretty brutal reality check from The White Coat Investor, which is a finance blog written by a physician who takes a very hard, very mathematical look at whether these strategies actually hold water for normal people.
Because it's one of the most polarizing debates in personal finance right now. I mean, are these whole life insurance strategies a secret wealth-building tool that you need to be using? Or are they just a high-fee trap?
Right, and just to be clear up front, our goal isn't to take sides or endorse either the infinite banking proponents or the heavy critics. We just want to impartially report on what these sources are claiming so you can make sense of it for your own financial foundation.
Exactly. So to figure out how to protect your own money, we first need to look at how the Rockefellers designed their system to avoid that Vanderbilt family fate.
Yeah, the Vanderbilt problem started at the very beginning. I mean, Cornelius just didn't believe in estate planning.
Which is wild for a guy with that much cash. He just passed the assets directly to his heirs, free of any trusts.
Yeah, and without the protection of trusts, that massive fortune was exposed to literally every possible threat. It was decimated by taxes, extravagant spending, divorces, creditors.
They essentially just handed over the keys to the vault and said, hope for the best.
Pretty much. But contrast that with the Rockefeller philosophy, which is famously summed up as, own nothing but control everything.
Own nothing but control everything. I love that. They didn't just hand over cash. They built a machine. And the sources call it the Rockefeller waterfall method.
Right. And the cornerstone of this method isn't like traditional stock portfolios. It's irrevocable trusts that own massive, permanent, whole life insurance policies.
Okay, so how does this waterfall actually flow? Because it sounds complicated.
It is a bit, but the architecture is structured in 4 distinct tiers. So think of tier 1 as the headwaters. Any excess family cash flow goes into a family holding company.
Got it. So just a big corporate bucket to hold the cash.
Exactly. Then tier 2 is where that holding company transfers the money into an irrevocable trust. And this is a vital step because it removes the assets from the taxable estate.
Because once the money is in that specific type of trust, it's legally separated from the individual, right?
Yes, which provides formidable creditor protection. It essentially acts as a legal fortress.
A fortress that then deploys the capital. So what's tier 3?
In tier 3, the trust takes those funds and buys high cash value life insurance on family members.
Wait, life insurance on themselves?
Yeah, on the family members. And finally, in tier 4, the trust uses the cash value of those policies to reinvest in the family. They finance new family businesses, pay for education, or provide loans to family members.
Oh, I see. And the genius of the waterfall seems to be what happens at the end of a generation. When an insured family member passes away, there's this massive death benefit.
And since it's life insurance, the payout is totally tax-free.
Exactly. It bypasses the estate tax entirely, drops right back into the trust, and the waterfall just restarts by purchasing new policies on the next generation.
The goal here isn't investing in the traditional sense of trying to beat the stock market. It's about transforming taxable liquidity events, like selling a business or passing on an inheritance where the IRS usually takes a huge cut.
Right.
It transforms those into recycled tax-free capital, capital that is completely shielded from lawsuits and managed under strict family governance.
It makes me think of the Vanderbilt fortune like a giant block of ice left out in the sun. Like every generation, every massive tax bill, every divorce, it just chipped away at the ice until it melted completely.
That's a great analogy.
But the Rockefeller fortune is more like a glacier that generates its own snow. It constantly replenishes itself. They essentially built a private family bank where they are their own best customer.
And they retain total control over the lending environment, which is huge.
Okay, but creating a family bank sounds incredible if your last name is Rockefeller, right? I mean, if you're a billionaire, setting up a complex web of holding companies and trusts is probably just, Tuesday.
Yeah, just another day at the office.
But if you're listening to this and you don't have an oil empire, how does this actual financial mechanism work for you? Because the sources talk heavily about this concept of cash flow insurance, and it apparently relies on some very specific IRS rules.
It does. The entire strategy hinges on Section 7702 of the IRS tax code. This section dictates exactly how life insurance must be structured to receive those incredibly favorable tax breaks.
Because historically, didn't the wealthy use life insurance purely as an unchecked tax shelter?
Oh, absolutely. They would dump millions into a policy just to hide it from the IRS. So the government finally stepped in and created mathematical ceilings.
They set limits on how much cash you could basically stuff into a policy.
Precisely. To keep its tax advantage status, a policy has to pass strict tests, primarily the cash value accumulation test and the guideline premium test.
Okay, lots of jargon there.
Yeah, but in simple terms, these tests just ensure the policy still acts like actual life insurance.
Yeah.
If the cash value gets too high relative to the actual death benefit, the IRS strips away the tax protections and treats it as a regular taxable investment.
So as long as you stay within the IRS limits, you get to play the game. And proponents of this, like Nelson Nash, who founded the infinite banking concept, they really lean into the philosophy of this game.
They do.
The sources actually mention Nash based his entire concept on Austrian economics. But hold on, Austrian economics is a massive macroeconomic theory. What does that have to do with my life insurance policy?
I know, it sounds like a leap. But in this context, Austrian economics emphasizes individual control over capital and an extreme skepticism of central banking systems.
Okay, so being anti-bank.
Right. Nash argues that traditional banking forces you to lose out on opportunity. If you put money in a regular bank, it's locked up, you earn a tiny bit of interest. But if you pull your money out to go buy a car, you lose all the future interest you could have made if you'd kept it invested.
Ah, I see.
Nash's philosophy is that you are always paying interest. You are either paying it to a bank to borrow their money, or you are giving up the interest you could have earned by using your own cash. It's the ultimate cost of lost opportunity.
Got it. So with cash flow insurance, the pitch is that you avoid that lost opportunity by borrowing against your policy's cash value, not from it. And they call this uninterrupted compounding interest.
Yes. This is the absolute core mechanic of the entire strategy. If you have $40,000 in the cash value of your whole life policy and you want to buy a car, you don't withdraw your $40,000.
You leave it in there.
Exactly. You use it as collateral to borrow $40,000 from the insurance company. Your original $40,000 stays in your account, totally untouched, and it continues to earn interest and dividends as if you never spent a single dime.
Wait, stop. I need to challenge this because it sounds incredibly counterintuitive.
Go for it.
If I'm borrowing against my policy, using it as collateral, the insurance company is still charging me interest on that loan, right?
They are, yes.
So why on earth would I pay an insurance company 5 or 6% interest just to borrow my own money? That makes zero sense to me.
On the surface, I completely agree. It feels like a scam. Why pay to access your own money? But the mathematical argument relies entirely on the long-term power of the compounding curve.
Okay.
Yes, you pay loan interest out of pocket, but your entire principal amount is simultaneously earning uninterrupted compound interest. Over a span of 30 or 40 years, the exponential growth of that uninterrupted capital massively outpaces the simple interest you paid on the short-term car loan.
Interesting.
Because if you drain a traditional bank account to pay cash for that car, you reset your compounding curve back to zero, you kill the momentum.
Let me see if I have a good way to picture this. It's kind of like owning a house, right? Say I own a house worth $500,000 outright. I need $40,000 to buy a car, so I take out a home equity line of credit against the house.
Right.
I am paying the bank interest on that loan. But my entire $500,000 house is still sitting in the real estate market appreciating. If the housing market goes up 10%, my house still gains $50,000 in value. It didn't drop to $460,000 in the market just because I borrowed against it.
That is the perfect way to look at it. You are collateralizing an appreciating asset so you don't have to interrupt its growth. And furthermore, when you do eventually take actual withdrawals from these policies in retirement, they are treated as FIFO, first in, first out.
Okay, translation time. So whenever you put money into something, the IRS usually wants to tax the gains when you pull it out.
Exactly. But FIFO is a massive tax advantage unique to permanent life insurance. It means you are pulling your original premium contributions out first, completely tax-free, before you ever touch the taxable gains.
Oh, that's clever.
It is. And to maximize this dividend growth and tax efficiency, proponents highly recommend using mutual life insurance companies, which are actually owned by the policyholders themselves, rather than stock companies, which are publicly traded and owned by Wall Street shareholders.
Okay, so being your own bank, recapturing that interest, letting your money compound uninterrupted, it sounds like a literal financial cheat code.
Wow.
But before anyone rushes out to sign a contract, we need to look at the catch. Because there is a massive catch.
There always is.
Why do so many traditional financial advisors absolutely despise whole life insurance? We have to bring in the reality check from the white coat investor.
We do. And the white coat investor perspective is a brutal but very necessary look at the actual math and behavior of everyday people trying to use billionaire tools.
Because we aren't all billionaires.
Right. The primary appeal of whole life is its absolute certainty. You know, guaranteed premiums, guaranteed death benefit, guaranteed cash value accumulation. The stock market might crash 20%, but your policy won't. But the problem is, you are paying a staggering premium for that safety.
How much of a premium are we talking about here? Can you give me the breakdown between a regular term life policy and this kind of permanent whole life policy?
Yeah, the cost difference is the entire crux of the debate. So let's say you're a healthy 35-year-old looking for a $1 million death benefit to protect your family. A standard 20-year term policy, which just pays out if you die and has no cash value, might cost you, say, $700 a year.
Okay, $700 a year. Not bad.
But a whole life policy designed to generate cash value for that exact same $1 million payout, that could easily cost you $15,000 a year.
$15,000 instead of $700.
Yep.
It sounds like buying a massive armor-plated tank to commute to work. Yes, it's undeniably safe. You will definitely survive a fender bender, but it's incredibly expensive to buy. It's agonizingly slow, and most people are going to end up abandoning it on the side of the highway because they simply can't afford to put gas in it every week.
And that abandonment issue is the darkest secret of the industry. The white coat investor highlights catastrophic lapse rates. We are talking about policies that people simply stop paying for.
Because they can't afford the 15 grand.
Exactly. Up to 25% of these policies lapse within the first 3 years. And if we look at the long term, roughly 80% of whole life policies lapse before they ever pay out a death benefit.
80% of people who buy this product walk away from it. That is wild.
Right.
And when a policy lapses, all those tax benefits we just talked about, they vanish.
Completely vanish. If you have outstanding loans against the policy and it lapses, the gains suddenly become fully taxable as ordinary income. You lose the policy, you lose your protection, and the IRS hits you with a tax bill.
Ouch.
It is a psychological trap. The people who are often targeted for these policies are those who feel they really need forced savings. But those are exactly the people who have variable incomes or high debt, like young doctors with student loans.
Right. Who cannot sustain a massive, inflexible $15,000 fixed premium every single year. When they hit a financial bump, the policy lapses, and they lose thousands of dollars to fees.
And we can't ignore the incentive structure making this happen either. The sources point out that sales commissions on whole life can be 50 to 110% of the first year's premium.
Wait, really? So if a broker sells you a policy with a $15,000 premium, they might pocket $15,000 in commission right out of the gate.
Exactly.
Bro.
As the saying goes, these policies are aggressively sold, not bought. No wonder Informal surveys show 75% of doctors regret buying them once they realize what they signed up for.
Wow.
And because of those massive initial commissions and administrative fees, the returns are dragged down significantly. In the initial years, the return on your investment is often negative. Even over the long term, if you hold the policy for decades, you might only see modest returns in the neighborhood of 2 to 5%.
So if the returns are so low and the costs are so high, why do the proponents from the infinite banking side hate traditional investing so much? Because in the sources, they go really hard against 401ks and mutual funds.
They do.
They act like putting money in the stock market is just a fool's errand. This really feels like a fundamental clash in financial philosophy.
It absolutely is.
Yeah.
Proponents of the Rockefeller method view traditional retirement accounts as fundamentally flawed and dangerous. They look at 401ks and see massive market volatility and a severe lack of liquidity.
Right.
Their core argument is that money in a 401k isn't really yours.
I noticed that detail in the text. They point out that on your retirement statements, it's technically labeled FBO for benefit of.
Right. The government sets the rules. You can't freely access your own money before age 59 and a half without getting hit with massive penalties and taxes.
So what's their alternative pitch?
The infinite banking pitch is a complete paradigm shift. They say, buy your net worth instead of building it. If you purchase a policy with a $5 million death benefit, you have instantly added $5 million to your estate's balance sheet on day one.
You just buy the end point.
Exactly. You don't have to spend 40 years putting money in an index fund, sweating through recessions, hoping the stock market goes up enough to reach that number. Furthermore, they argue that knowing that guaranteed $5 million death benefit will eventually replenish your estate, it allows you to spend 20 to 50% more of your cash flow during retirement with absolute certainty.
Because you can spend down your other assets knowing the insurance will replace them for your heirs.
Precisely.
But the white coat investor completely rejects this comparison as a wealth accumulation strategy. They run the numbers on that same massive premium to see what happens if you just invest it normally. Can you break down that math for us?
Sure, and the math is sobering. Let's take a high-income earner who could afford a $53,000 annual premium. If you took that $53,000 every year and invested it into a Roth account earning an average of 8% in the stock market over 30 years, it grows to roughly $3.58 million.
Okay, $3.5 million.
But what if you put that same premium into whole life? The projected return, assuming the insurance company performs well, is only $1.65 million, and the guaranteed return is just $700,000.
So you're looking at $3.58 million in the market versus a worst-case guarantee of $700,000 in the insurance policy. If the guaranteed return of whole life is basically equal to inflation around 2 or 3%, aren't you actually losing purchasing power over time?
Yes.
You are paying a massive premium, sacrificing millions in potential growth just to avoid stock market dips.
It's fundamentally a battle between risk tolerance and growth. The traditional buy term and invest the rest strategy, buying a cheap term life policy and putting the massive difference into index funds, wins massively on total wealth accumulation.
But it requires the emotional stomach to endure market crashes and volatility.
Exactly. The whole life strategy wins on absolute certainty, creditor protection, and guarantees. But you pay an enormous premium for that comfort.
Okay, so we've seen the billionaire pitch, the infinite banking concept of uninterrupted compounding, and we've seen the brutal mathematical takedown from the physician community. So where does the truth lie? Who should actually use this, and how does it apply to someone trying to figure out their financial life today?
Well, even the white coat investor, who is highly critical, concedes there are absolutely legitimate niche uses for whole life insurance. It is not entirely without merit, but its utility is highly specific.
What are those specific scenarios? Because it sounds like you have to have a very particular set of problems for this to be the solution.
You do. First, estate planning. If you have a massive estate, say a $50 million family farm or a manufacturing business, your heirs might owe millions in estate taxes when you die. An irrevocable life insurance trust, or an ILIT, provides instant liquid cash to pay those taxes so they don't have to sell off the family business to pay the IRS.
Okay, that makes total sense. What else?
Second is business buy-sell agreements. If you own a company with a partner and they die, a whole life policy pays out cash so you can immediately buy out the deceased partner's shares from their grieving family.
What about asset protection? We mentioned earlier that the Rockefellers used trusts to shield their money from creditors.
Yes, in certain states, the cash value of life insurance is completely shielded from bankruptcy and creditors. If you are in a high-risk profession where you get sued constantly, it's basically a legal vault.
Got it.
Fourth, if you have a dependent with lifelong special needs who will always require financial support after you are gone, a guaranteed permanent death benefit provides absolute certainty.
Which is invaluable.
Right. And finally, for ultra-high net worth individuals, it can act purely as a conservative bond replacement, just a way to hold a large chunk of tax-advantaged fixed income outside of the volatile stock market.
All right, let's bring this down to earth for a second for the listener. Unless you're a business owner dealing with a massive estate tax problem, trying to protect assets from high-risk lawsuits, or actively trying to replicate a 100-year Vanderbilt-style trust, you probably want to stick to the basics.
Most likely, yes.
Build your wealth in the market, build a highly liquid emergency fund in a regular bank, max out your 401k and Roth accounts, and just buy cheap term life insurance to protect your family while you are still working.
I think the foundational takeaway here is that purchasing a permanent whole life policy is a lifelong financial commitment. It is very much like a marriage. Exiting early is incredibly painful and expensive. It is not a get-rich-quick investment.
Right.
It is a highly specialized legal and financial tool designed to protect wealth that already exists rather than to create wealth from scratch.
To wrap up this deep dive, we've explored the Rockefeller waterfall, looking at how they use trusts and life insurance to recycle wealth generation after generation. We broke down the mechanics of Section 7702 and the mind-bending appeal of uninterrupted compounding.
Yeah, and we also confronted the high costs, that devastating 80% lapse rate, and the stark mathematical reality of whole life returns, ultimately defining exactly when it makes sense to deploy these heavy-duty strategies.
But we spent a lot of time today focusing on the financial products the Rockefellers used. Is there anything else?
There's one final really vital concept mentioned in the sources that we haven't touched on yet. The sources note that the Rockefellers didn't just use trusts and insurance, they utilized a family constitution and a statement of purpose.
Oh, that's fascinating, because the Vanderbilts didn't just lack trusts, they lacked shared values. I mean, they gambled, they drank, they bought lavish estates without any underlying purpose or financial education for the next generation.
Which leaves us with a critical thought to end on. Even if you don't have $10 billion or a massive whole life policy, what is the intellectual and moral legacy you are leaving behind?
Wow, yeah.
Because a well-funded trust, handed to heirs who have no financial literacy or shared values, is just a slower, more complicated path to the exact same Vanderbilt ruin.
This is such a good point to reflect on. What are the rules of your family bank? Thank you for joining us on this deep dive. Take a close look at where your own money is flowing, and we'll catch you next time.